Well, stackers rejoice, I think, is the answer when it comes to the physical metals. But to answer your question more seriously, I think when you get a crisis of this sort, the immediate move is into perceived security, which is the dollar, because it's liquid, it's big, it's liquid. So what do? You rush out and buy dollars. And if you look at the dollar's trade weighted, it has indeed risen from 96 to about 101. So I think that's a lot of the answer. Inevitably, once people actually sort of think things through, you find that there's a backwash out of the dollar into the precious metals. And we saw this in the wake of the 2008-9 financial crisis, when gold fell from around about $1,000 down to a low of $680 before going on to, 1920 or something in September 2011. So this is, I think, normal behavior. The first wave is into the dollar. And of course, the professionals, if you like, in the market, the bullion banks running positions and, the large hedge funds will look at this as an opportunity to get prices down so that they can buy these metals at discounted prices. So that, I think, is the initial effect.
According to Alasdair Macleod, it's normal for gold and silver to fall at the beginning of a crisis. He points to what happened after the 2008 financial crisis, when gold first dropped from about $1,000 to around $680, before later rising strongly to nearly $1,900 by 2011. He explains that in the early stage of a crisis, investors usually rush into cash. Today, that mostly means the US dollar because it is the most liquid and widely used currency. So instead of buying gold right away, many investors first move their money into dollar-based assets. This helps explain why the dollar can go up at the same time gold and silver go down in the beginning. Macleod also says that large players like banks and hedge funds may use this period to push prices lower and quietly buy physical metals at cheaper levels.
When you look at the mining sector, the mining sector has been running very, very powerfully. So if you're, let us say, losing money on your Nvidia or your Tesla or your, Microsoft or your whatever it is, then what do? Do you sell the things you're losing money on? No, you don't. You sell the things that you made a profit on. And that inevitably, I think, is putting pressure on the mining stocks. So that would be my view. Again, if you're a trader in mining stocks, you count up to 10 and then just buy the socks off it. It's not a positive for China. China is protecting herself. That is the key. She wants to protect her own currency from the inevitable collapse of the dollar. And her moves, if you like, have been very, very much in that direction. She's taken the simple approach. Why interrupt America when it's making all the mistakes? But, a key example of this was, the rare earth incident back in late September. America, Trump threatened, I think, 145% tariffs or something. So the Chinese turned around and said, okay, well, we're not exporting any rare earths. That was almost, it wasn't quite, but it was almost the first proactive move that they made against America. What we didn't know at the time was that it wasn't just rare earths, but at the time China took the view that it should stop exporting silver as well, which is why the silver price took off. And literally within 2 or 3 weeks, there was a delivery crisis in London because the liquidity suddenly wasn't there. The Chinese obviously took the view at the time when the Americans decided that silver was a critical mineral. Why supply Western markets when, America, if you like, will be trying to stockpile this new critical mineral? There's no point. Well, I wouldn't be surprised. I don't forecast prices. That's the first thing I must make clear. But I wouldn't be surprised because, even though, I will claim, I hope you believe me, that I got a better understanding of what the hell's going on than the average investment manager we have to bear in mind that the average investment manager is a macroeconomically driven individual. And macroeconomics is a false economic science. It doesn't actually exist in reality. So consequently, everybody in the investment game is basically making decisions which are divorced from reality. Eventually, that sorts itself out. As they say, the market always gets it right in the end. But there are quite long periods where the market gets it horribly wrong or goes to places for completely the wrong reasons. And when you get a chaotic situation such as we have at the moment, then that's what's going to happen. It's quite simple. There are big lies being told. I mean, for example, they talk about, speculators, getting out of gold and silver. Now, come on, the speculators do not have positions in gold and silver. They're minimal. I mean, just look at the open interest in silver, which I referred to earlier. If you look also at the longs, if you like, in the COMEX longs in the gold contract, they're as low as they've been for some considerable time as well. I mean, the net figure obviously is slightly changes because then you're looking at the other side of the transaction as well. So, yeah, we've seen this before. It produces volatility, which is unreasonable. And I'll give you another example of where the whole thing is mispriced. If you understand what gold really is, gold is final settlement. It is real money. Everything else is credit. This was originally said by John Pierpont Morgan back in 1912, and it's still true today, even though, nobody thinks it, but it is true. The long-term purchasing power of gold is remarkably steady. Okay. Now, so how do you explain the situation where, if you look at the value of base metals measured in gold, they should be not too far away from that steady level. But actually, if you look at an index of base metals, it's around about 25% of that long-term value. In other words, what fiat currencies have done is they have concealed a substantial decline in the value of base metals. Those base metals will normalize. So even without a change in the purchasing power of the dollar, you are likely to see base metals rising on average by roughly 300% to get back to normality. Now, if you put on top of that a declining purchasing power of the dollar, then who knows where it goes? In other words, I mean, and this is true of all commodities, incidentally. I've just taken base metals as an example. But food is an interesting one. Agri-products, as it were, are an interesting one because that similarly is depressed. And so we are likely to see in real terms a substantial rise in their value. Not only that, but with the shortage of fertilizers as a result of this ridiculous attack on Iran and their response and the closure of Hormuz. And at the same time, I mean, what's that going to do to food prices? Even if there is no further decline in the purchasing power of the dollar or sterling or the euro or the yen. They're going to go through the roof.
Growing use of the financial system as a political tool. Heavy sanctions, rising deficits, and large amounts of money creation are making some countries question the stability of the current system. As trust in paper currencies weakens, more governments and investors are looking for alternatives. Because of this, demand for physical gold and silver is increasing around the world. Some analysts believe this shift could create strong pressure on supply if more countries and investors try to secure real metal instead of paper assets tied to it.
Every fiat currency system has collapsed in the past. This one is in the waiting room. It is, if you like, it's in the funeral parlor, let's put it that way. I mean, your reference to the 70s is interesting because the 70s and this decade basically are bookending the fiat currency system. I mean, the fiat currency system survived the 70s just but only just. And the reason it survived was because you had a Fed chairman in the form of Paul Volcker, who said, we've got to rescue the dollar. It's obviously sliding. We have to raise interest rates to whatever it takes. And he raised in those days, I think it was the prime rate, up to 19.5%. He killed the savings and loan industry. I mean, that all fell apart. But it stopped the inflation and led to a period of stability with declining bond yields, if you like. I mean, they fell. But even that long period between 1981 and sort of 2016, even that long period sowed the seeds of the destruction of the dollar. Because what happened was you had the first real carry trade developed, which basically was, you would lease gold at 1%, sell it into the market for dollars, invest the dollars in T-bills, which were giving you anything from 10% in the early days and sort of declining down to 5% by the end of the last century. And you leveraged it up, and it was wonderful. But, of course, where did you, how did you get your gold back? Well, the answer is you didn't. It just rolled and rolled. And, I've quoted this so often. Frank Venerosa, analyst, looked at this. He spoke to people, who wouldn't talk nowadays because the whole subject has become so sensitive. But in those days, he could talk to all sorts of people, including the head of foreign exchange at the Bank of England, who I knew personally. I used to lunch with him occasionally. And he concluded by around about 2002 that between a third and a half of all official central bank reserves had gone out on lease. And the way he put it was, and it's probably adorning the necks of Asian women. Now, he was right about it going out on lease, but there are two things in here. Firstly, it didn't go out and adorn the necks of Asian women. Because, I mean, if you look at India, for example, the Gold Act, I think, whereby gold was restricted to, it was illegal to import gold. I think that was about 1992. No, China was in there picking it up. So China bought all that gold. Now, who actually leased it and hasn't got it back? Well, it's quite clear. It's the Americans. So they don't have the 8,130 odd tons, which they claim to have on the US Treasury's balance sheet. No, most of that's gone. And indeed, we had this confirmed because they also raided the earmarked gold held in the New York Fed. So, we discovered this when Germany said, "Oi, we'd quite like a little bit of our gold back." Ooh, it's going to take you 7 years for us to deliver it to you, was the eventual agreement. So when we go back onto a metallic standard, which incidentally was all set out in Roman law, which is the basis of our common law recognition of the difference between money and credit. And I don't care what governments say, that is actually still the position. The answer is that America does not have its gold to defend the dollar, even if it wanted to go back on a gold standard. And that is why successively people who have become, gone from outside into government and been appointed, if you like, in positions of responsibility, have started off saying, we need to audit the gold. And when they get into position of responsibility, suddenly, stum. And that, Besant, very good example. So, this situation is very, very bad for the dollar. So we're now in the final stage. So we've had the first bookend, and now we've got the second bookend. And quite frankly, I think that what we're seeing in terms of what's driving things in America and will drive things is politics, not economics.